Is Nebius Group N.V. the ultimate generational strong buy in the AI space right now? Or is this massive 600% surge just a perfectly disguised value trap, waiting to catch retail traders flat-footed?
I mean, that is the $40 billion question today.
Right. Welcome to the deep dive, everyone. Today, we are looking at a company that is essentially pouring the concrete for the whole AI revolution.
Yeah, laying the physical foundation.
Exactly. Our mission today is to just completely tear into the machinery behind Nebius. That's ticker symbol NBIS. We're going to pull apart their financials, dissect the market psychology that's driving this crazy stock price, and really try to figure out if the underlying business can actually support a $40 billion valuation.
Because frankly, the numbers are defying gravity right now.
They really are. And as we get into these numbers, I want you to let us know down in the comments if you think this is like the buy of a lifetime or a mathematical trap. We want to know where you stand. And hey, take a quick second to like and subscribe to the channel, whether you're listening on audio or watching us on YouTube. It helps us out, and you'll never miss one of these breakdowns.
So to ground us in reality before we get too deep in the weeds here, as of today, April 21st, 2026, NBIS is trading at $161.49.
Which is up, what, nearly 3% just today?
Yeah, plus 2.77% today. It's riding this incredible long-term bullish wave that has just entirely captivated the market.
Oh, absolutely.
But, when you have a stock that runs from $20 to over $160 in a single 52-week window, you inevitably start seeing some structural stress fractures behind the scenes.
Right, and I want to start right there with those stress fractures. Because how does a company actually pull off a 600% surge in 1 year?
It's all about the top-line growth.
Yeah, because when you look at their trailing 12-month revenue, it's sitting at $529.8 million.
Which is a staggering 350% year-over-year increase.
350%. I mean, on paper, that level of growth is just intoxicating for an investor. And they even posted a positive net income for 2025, right? Like $101.7 million.
They did, yeah.
For the full year.
And this is a massive, but the moment you look at the fourth quarter of 2025, that illusion of profitability just completely shatters.
It really does.
They posted a net loss of almost $250 million in a single quarter, and their operating income for the year is sitting at negative $596.2 million.
Yeah.
So I have to ask you, how do we reconcile 350% revenue growth with a $500 million operating loss? Like, is a $250 million net loss in 1 quarter a giant red flag, or is that just the table stakes for playing in this AI infrastructure game? You really have to reconcile it by understanding that Nebius isn't a traditional software company.
Right.
In the traditional tech world, you write a piece of software once.
Yeah.
And distributing it to 1 million new users costs almost nothing.
The margins are basically 100%.
Exactly. Beautiful margins.
Yeah.
But AI infrastructure is a brutal, intensely physical business. That negative $596 million operating income, that is the direct result of having to procure land, secure massive power contracts, and physically build these specialized data centers.
Because they have to cool tens of thousands of these advanced GPUs.
Right. They are in a hyper-growth phase where every single dollar of incoming revenue, and honestly then some, is immediately fed right back into aggressive R&D and physical expansion.
I always think of it like building a massive futuristic luxury hotel.
That's a good way to look at it.
There are these colossal upfront costs before a single guest ever checks in and pays for a room. But let's talk about the physical reality of that expansion, because their balance sheet is fascinating.
It's definitely heavy.
Yeah, they have total assets of $12.5 billion against total debt of $4.89 billion. And they're sitting on $3.68 billion in cash.
And their current ratio is 3.08, which is actually very strong.
Right, showing they have more than enough liquid assets to cover their short-term liabilities. But those assets aren't exactly liquid, are they?
Well, no.
Because if I'm an investor looking at $12 billion in assets, I need to know what that actually represents. Are we just talking about warehouses full of depreciating computer chips?
I mean, literally, yes. That is exactly what we were talking about. But you have to view those chips differently than normal depreciating hardware.
How so?
When Nebius buys a massive cluster of Nvidia GPUs, they aren't just buying office equipment. They're buying digital toll booths on the highway of the future internet.
Okay, I like that. Toll booths.
Every single AI model that Meta or Microsoft wants to train has to pass through one of those coal booths.
Yeah.
And Nebius collects the fee. So yes, the assets are largely physical servers, but they are incredibly rare, highly coveted, revenue-generating assets. Honestly, if they simply stopped expanding today, they would show a massive operating profit tomorrow.
But they can't stop.
Exactly. An AI arms race. Pausing your expansion means you lose your market share by the end of the year. You just become irrelevant.
Well, you bring up the cost of those toll booths, which pushes us right into, honestly, what I think is the most alarming part of their financials, the cash flow statement.
Oh yeah, the cash burn bonfire.
It is a bonfire. Because if they are laying concrete and installing all these digital toll booths, the money leaving the bank account is just astronomical.
Yep.
In 2025, their cash from operations was actually healthy. They brought in $384.8 million from their core business.
Which shows the business model works.
Sure, but their capital expenditure, their CapEx, was negative $4.07 billion.
Right.
$4 billion spent building out these GPU clusters. That leaves them with a levered free cash flow of negative $3.61 billion.
It's a massive number.
It is. And I have to push back on your toll booth defense here, looking right at the listener. If a company is burning $3.6 billion a year, but only has $3.68 billion in cash in the bank, they have a literal ticking clock counting down to zero.
Oh, the math is the math.
How is a negative $3.6 billion cash flow not a massive screaming red flag?
Well, it is red flag if you look at it without the context of their pipeline. I mean, it's the ultimate bear argument, and it is entirely valid. The cost of staying relevant in AI is merciless.
Merciless, yeah.
But let's break down how that CapEx actually functions. That negative $4 billion isn't money being thrown into a furnace. It is front-loading the next 3 to 5 years of revenue.
Because the clients are already waiting.
Exactly. When they buy those clusters, they already have contracts lined up to rent them out. Is the runway tight? Absolutely.
Yeah.
At their current velocity, that $3.68 billion in cash buys them roughly 1 year of runway.
1 year, wow.
Right. So the entire thesis of this company rests on the assumption that as these newly built GPU clusters come online over the next few quarters, the operating cash flow is going to scale up violently to offset that CapEx burn.
And if it doesn't?
If it doesn't, or if there's even a slight delay in getting those data centers fully operational, they hit a brick wall.
And then what?
They would be forced to issue more debt in a tight credit market, or they would have to issue millions of new shares, which, dilutes the value of the stock currently held by everyday retail investors.
Which brings us to a really interesting psychological disconnect here. The fundamental reality shows a company walking a very, very tight financial tightrope. Yet the market does not seem to care at all.
No, the market is eating this up.
The price action on the chart is telling a completely different story from that cash flow statement. We mentioned the 52-week range earlier, $20.25 to a high of $168.71.
Historic run.
It's ballooned to a $40.27 billion market cap. The trend is violently bullish. At 161.49, it is light years above its 50-day moving average, which is at 112.10.
Right.
And it's way above the 200-day moving average of 94.38. From a purely mechanical standpoint, every major trend indicator is flashing a strong buy. It's like the stock is running a marathon at a sprinter's pace.
And that, right there, is exactly where the danger lies. A stock simply cannot sprint a marathon indefinitely. The technical indicators are showing severe exhaustion.
Okay, let's dissect that exhaustion. The relative strength index, the RSI, on the 14-day chart is sitting at 87.26.
Which is incredibly high.
We hear the term overbought thrown around a lot, but explain what an RSI of 87 actually means for the person holding this stock right now.
Sure. So RSI is essentially a momentum speedometer, right? It runs from 0 to 100. Generally, anything over 70 means the stock is officially overbought.
Okay.
At 87, it means the buying pressure is statistically tapped out. Practically speaking, it means that almost everyone who wants to buy Nebius have already bought it.
Ah, so there's nobody left to push it up.
Exactly. There is no fresh capital rushing in to push it higher. It suggests that, purely from a statistical standpoint, gravity has to kick in. The stock needs a period of consolidation or a direct pullback just to catch its breath.
And the MACD reflects that too, right?
Yeah. The MACD is sitting at 14.78. It's technically still a buy signal, but the momentum is clearly decelerating.
But gravity doesn't exist in a vacuum, especially with this stock. because we have a massive anomaly in the short
Well,
interest.
the short interest is the wild card here.
Right now, 20.88% of the float, which is over 42 million shares, is sold short. That means a massive chunk of the market is actively betting that this stock is going to crash.
Wow.
If the RSI is screaming that the buyers are exhausted, who are these people shorting a company that literally provides AI infrastructure?
They are likely institutional macro funds. They look at that $3.6 billion cash burn we just discussed. They look at the $40 billion market cap, and they make a bet that the hardware cycle is peaking.
They think the hype has outrun the reality.
Exactly. They believe Nebius is overvalued and is bound to slide back down to test its key support levels. And if you look at the chart, that immediate support is down at 155.37.
And below that.
There's a much deeper structural floor waiting all the way down at 132.35.
Wow. But doesn't that 20% short interest create a powder keg? Like, if the shorts are wrong and Nebius gets even a tiny piece of good news, what happens?
That is the ultimate tug of war defining this stock right now. If momentum fades, yeah, it drops to 155. But if there is a positive catalyst, those short sellers, all 42 million shares worth, will be forced to buy the stock back to cover their losing positions.
And that creates the squeeze.
Exactly. That forced buying acts like rocket fuel. It would easily blast the price straight through its immediate resistance at the 168.71 high and just push it rapidly toward the next technical target of 191.95.
Okay, so we have overbought technicals screaming for a pullback and this massive short interest creating the conditions for a violent upward squeeze.
Hustle gridlock.
Which brings us to the professionals. What are the analysts and the insiders doing while this tug of war plays out? Because looking at the consensus ratings, it's mostly buy and strong buy.
Right.
There are 11 buys, 4 holds, and only 1 sell, but the price targets are just incredibly scattered.
They are all over the place.
The average target is $170.29. The highest analyst target is all the way up at $291, and the lowest is sitting at $85.
Wow.
That is a 240% difference in professional opinion. What does that spread actually tell us?
It tells you that the professional analysts fundamentally disagree on what this company's infrastructure is actually going to be worth in 2 years.
Interesting.
The analyst at $85, they're looking at the cash burn and the execution risk. The analyst at $291 is looking at the total addressable market of the AI industry, and assuming Nebius just captures a massive slice of it.
Okay, and what about the insiders? We see data showing that institutions have been accumulating shares pretty aggressively, but then we have a very specific insider transaction from just a few days ago.
Right, on April 16th.
Yeah, April 16th, 2026. Insider Mark Boroditsky sold 4,500 shares. Now, I know insiders sell for all sorts of reasons, tax obligations, buying real estate, but when you combine an insider taking profits near the 52-week high with the valuation debate we are having, does it add psychological weight to the idea that retail traders might be walking into a trap here?
Oh, it absolutely adds psychological weight. I mean, the optics of insider selling are never great when a stock is priced for perfection.
And it is priced for perfection.
Nebius is undeniably priced for perfection right now.
Let's drill into that valuation, because some conservative models out there put the fair value of this stock at just $45.62.
Yeah, the DCF models.
Right. If that mathematical model is correct, the current price of $161 is a 244% premium. Furthermore, their price-to-earnings ratio, the PE ratio, is sitting over 300.
It's massive.
I have to ask, how can anyone justify a 300 PE ratio? I mean, think about jumping onto a rocket ship right as it runs out of fuel. Are we looking at a classic scenario where retail investors are lured in at the absolute top, paying a huge premium for a company that is fundamentally worth a quarter of its current price?
This is where we really have to debate the usefulness of a traditional discounted cash flow model in a hyper-growth industry.
Okay, unpack that.
So the models putting the fair value at $45 are analyzing Nebius based on its current tangible earnings. By that traditional metric, yes, paying a 244% premium is terrifying. A PE ratio over 300 means investors are paying an enormous premium for every single dollar the company earns today. But the bullish argument, and honestly the reason institutions are still buying, is that you aren't buying the company for what it earns today.
Buying the future.
Exactly. You are buying it for what its infrastructure will yield tomorrow. Applying a traditional fair value model to a company building the foundation of a new technological era often results in the stock looking chronically overvalued, literally right up until the moment it dominates the market.
That sets up the ultimate bull versus bear debate perfectly. Let's weigh the gravity of that 300 PE valuation against the rocket fuel of their future growth. Let's start with the best case scenario.
The bull case.
Yeah. The core of the bull case is that Nebius isn't just renting out server space, they are positioning themselves as a full-stack AI infrastructure provider.
Right. They do it all.
And they have preferential access to Nvidia GPUs, which are basically the global reserve currency of the modern tech sector right now. But what really anchors the bullish argument is their massive contract visibility.
Hyperscaler deals.
Exactly. We are talking about a finalized $27 billion deal with Meta and a $19.4 billion deal with Microsoft.
Just staggering numbers.
Why are tech giants of that size relying on Nebius instead of just building the infrastructure themselves?
Because building data centers takes time, and securing the massive amounts of electricity required to run them is becoming incredibly difficult.
But the power grid just isn't ready.
No, it's not. Nebius went out early and secured the land, they secured the power grid access, and most importantly, the GPU allocation from Nvidia. Meta and Microsoft are in an absolute arms race to train their next-generation AI models. They do not have the luxury of waiting 3 years to build their own dedicated facilities from scratch.
So they just buy the capacity.
Right. When Meta signs a $27 billion contract, they are guaranteeing they have the compute power necessary to stay relevant. For Nebius, these deals create a massive, long-term revenue floor.
Right.
The company's overall revenue is projected to hit $10 billion by 2027, and that's based almost entirely on these locked-in contracts. That contract visibility is why bulls are perfectly comfortable ignoring the $45 fair value model. The revenue is practically guaranteed.
But the bear case looks at that exact same situation and sees a massive vulnerability. Let's look at the worst-case continuation lower.
Okay.
The bears argue that an extreme 300-plus PE ratio leaves literally zero room for error. We already established that their business model is currently burning $3.6 billion a year.
Yep.
What happens if there is a supply chain hiccup? What if Nvidia delays a shipment of their newest chips by, say, 6 months? Or what if a regional power grid can't actually support the energy draw of Nebius's new data center expansions?
Those are very real risks.
The bears argue that if any of those execution errors occur, a 300 PE ratio will just collapse under its own weight.
Precisely. And the bear argument isn't necessarily that Nebius is a fraudulent or a failing company.
Right. They're a real company doing real things.
Exactly.
Yeah.
The argument is simply that it is a perfectly fine company that is currently priced as if it has already flawlessly executed its 10-year plan.
Priced for perfection.
Right. When you are priced for perfection, good news isn't enough to keep the stock moving up. It has to be spectacular news. Any slight delay in cluster deployment, any regulatory hurdle regarding energy consumption, and that valuation premium vanishes overnight.
So how does this all play out in the near term? I mean, in the medium to long term, Nebius is entirely focused on building out their European and North American GPU clusters, trying to convert a $46 billion total pipeline into recognized top-line revenue.
Right.
But we have a massive short-term catalyst right around the corner.
The earnings report.
Yes, the upcoming earnings report is scheduled for April 29th, 2026. The broader market expects them to confirm revenue guidance of $3 billion to $3.4 billion for 2026.
Yep.
With the stock price stretched this thin, is this upcoming earnings call the ultimate make or break moment?
It absolutely is the defining moment for their next major cycle.
Yeah.
I mean, think about the tension we've outlined today. The RSI is at 87, so buyers are exhausted.
Right.
You have 20% short interest just waiting to pounce or be violently squeezed. If management comes out on April 29th and softens that guidance by even 5%, or admits to a minor delay in their CapEx deployment,
The bottom falls out.
those overbought technicals will violently correct, and the shorts will drive the price right down to that $132 floor.
Wow.
But if they beat expectations, confirm the $3.4 billion guidance, and show that their profit margins on the new clusters are higher than anticipated, it could be the spark that forces those short sellers to cover, igniting a massive, massive squeeze.
It is an incredible financial tightrope, truly.
Yeah.
Just to summarize what we've uncovered today for you guys. On one side, Nebius boasts a 600% gain, an expanding network of digital toll booths, preferential access to Nvidia hardware, and multi-billion-dollar foundational partnerships with Meta and Microsoft that are driving a $46 billion pipeline.
This huge bull thesis.
It is. But on the other side, you have deeply overbought technical signals, a massive cash burn resulting in negative $3.6 billion in free cash flow, insider selling at the peak, and a valuation model that demands absolute perfection. It's the very definition of a high-stakes environment.
Totally.
Before we wrap up, a quick reminder for everyone tuning in. This debate, the analysis, and all the numbers we discussed today are purely for educational and entertainment purposes.
Always do your own research.
Exactly. This does not constitute financial advice. We are here to help you understand the mechanics of the market, but you have to make your own investment decisions.
You know, we know the current valuation requires flawless execution from management. The market is happily looking past the massive cash burn because they believe the Meta and Microsoft's contracts are ironclad.
Right.
But I'll leave you with this. If you have a 300+ PE ratio resting squarely on the assumption of uninterrupted hypergrowth, what happens to this $40 billion house of cards if just one of those tech giants decides to delay their AI infrastructure spending by a single quarter?